Hello, everybody. My name is Ryan McNeil. This is the Builder by Day podcast. Today, I'm chatting with a friend of mine, Kyle Selig, mortgage specialist, RBC. This is my fourth time doing this, so basically, I'm a professional.
Absolutely.
I mean, I know everything there is to know by this point, but
you're in the big leagues.
But you haven't, so I'll take it easy on you, and I'll just try to dumb it down for you as much as possible.
We'll try. Okay. We'll try our best.
So, we're going to obviously talk some mortgage stuff today and financing and so on, and we'll talk about how that relates to new construction and my world. But not only that, we'll talk about some stuff that doesn't relate to new construction as well. Maybe just fill everybody in a little bit on who Kyle Selig is professionally and how long you've been doing this and what you do and
feels like forever.
Yeah.
No, born and raised in the Valley, actually. Born and raised in Kentfield, Nova Scotia, but been with RBC for going on 15 years now.
Okay.
Been doing mortgages as part of my role for all 15 years, but dedicated mortgage specialist for the last 7.
Okay.
But I did dabble in a little bit in investments, and obviously when I started with RBC, I kind of did everything. But my true passion was homes, like everything, new construction, resale, you name it. And I'm like, I need to be a mortgage specialist. Okay. That's what it is.
That's good. So you like what you do?
Love it.
That's good.
Absolutely love it.
I like what I do too. I love what I do too.
Yeah.
It's a big difference. Like when you wake up in the morning, I assume you're probably like me. You don't ever really feel like you're going to work.
No.
You're just doing what you do.
I'm just trying to get the kids out the door first.
Well, there's that too. Right? Yeah, my kids are older now.
And
my wife, she knocked that out of the park, so she always had that under control.
Yeah, she's good there. Right? Yeah. No, it's enjoyable. Like I love talking to people. First of all, like you could sit here and talk to me for hours on end, but whatever.
We might.
But hey, it works. But at the end of the day, I like helping people, and that combined with me just loving homes, like it all started with looking on realtor.ca and just looking at the QE2 show homes and things like that. You know, just like, oh, I love this. This is cool. And luckily working for RBC, there was a position or a role that you could get into that would be doing that every day.
So what did you do before you were on the mortgage side at RBC?
So right before that, I actually had my full PFP, my financial planning designation, and I'd worked with investments on the investment side of things, so getting people into the right investments for retirement and savings. And then when I first started with RBC, at an entry level role, it was, I was doing your visas and credit cards and things like that. But yeah, I was a financial planner for 3 or 4 years before that came along, and I realized, I'm like, I want to be doing something with homes.
Yeah, that's good. That's good.
8 years later, I feel like I started yesterday.
Yeah, good. You've been at the same place for 15 years. Nowadays, not many people can say that, really. People bounce around a lot.
Big time.
These days, for various reasons, but RBC is a good company. I do, this will be my RBC pitch here for the first little bit, but I've been a banking customer of RBC my whole life.
Well, thank you very much.
Like when I was 12 years old, I set up I think it was called a Leo the Lion bank savings account.
It's still called Leo.
I still have it. I still have that account. I actually, years ago, maybe 10 years ago, I remember at one point having a conversation with somebody, and I said, somebody at RBC, and I think, I should probably close this account. I don't use it. And they're like, oh my God, don't close it. It's like some kind of no fee.
Yeah.
Yeah, it's just, I'll have it forever.
Kept along. Absolutely. I remember opening mine when I was 7 years old in the New Minas branch.
Okay.
Right in the mall in New Minas. And I still have that account to this day.
That's good.
It's kind of like your badge, right?
Yeah.
You had it right from the start. But
that's back when you used to have to go physically into the bank, see a teller, and ask for some of your money. Can I have some of my money? Right? Can I have 10? I can remember being in high school. This is probably dating me a bit here now, but I remember going in to see a teller, like when I was in junior high. You needed some money for something. You'd have to go into the bank.
Yeah.
So you could only get money when the bank was open.
Yep.
And there was no Sunday shopping, and there was no weekend banking. So if you forgot to get money before end of day on Friday, and you wanted some dough for the weekend, you were up the creek.
In some banks, in some different branches, like it would be a 3 o'clock close way back.
Yeah.
Right? Not even 5 o'clock.
Banker's hours.
Banker's hours. That's where it comes from. Trust me. If you saw my hours, it's not banker's hours.
No, you're not a banker. You're not a banker. You're more of a self-employed type of routine. Yeah.
But definitely an employee of the RBC and through. And
excellent.
We do it with our family. My wife's a financial planner with RBC as well. So, we're
a family affair.
33, 34 years plus in the banking world. So it's great.
That's good. That's good, man. So what's going on in the world of mortgages these days? That most people that are paying attention, of course, are aware that rates have been coming down.
Yeah,
so that's nice.
Thankfully,
that's nice.
Yeah, it's very nice. It's been a roller coaster 4 or 5 years, and definitely the same in your business too.
Yeah, that was wild. COVID was wild.
It was absolutely ridiculous.
Man. I don't need that to happen again.
No, it was a lot.
And people often say, and rightfully so. I know why they say it. I mean, I get it. People would say, you guys must have home builders. You guys must have loved COVID. Prices going up, and you couldn't build them fast enough, and people were buying everything. Like, yeah, that part's true, but those were not my favorite 2 or 3 years. Not even close. Not even close. That was not fun.
There's being busy, and then there's being
stupid
frantic.
Busy. That was frantic.
Yeah.
That was too much. So we can do without that. Well, hopefully that won't happen again.
Yeah.
And it was, and how it went. And interest rates were like where
Crazy.
they have never been before.
Under 2 for a fixed rate, and low ones, if not 1 for a variable rate.
Yeah, money was so cheap.
Oh, it was absolutely crazy. And with home prices going up at that point, and you can attest that your cost to build's going up at that point, changing on the daily, lumber and things like that. And
yeah, that was unnerving. COVID wasn't pleasant.
It wasn't. And on my end, with rates being so low and people wanting to get into homes, and I feel like the shortage people just I need to get a house now. I need to get a house now, right?
Yeah, there was like this panic sensation.
Exactly.
It's like, if I don't buy something now, I'll never get a house.
Right.
Right. Yeah.
And it was absolutely crazy. Absolutely. It was, not saying I don't see my kids, but it was, you're spending really long days, long nights. And you know what? It's just mentally, it's exhausting, right? It catches up to you after a little while, but,
and it's, we're both in the same industry where you're providing mortgage for people that are buying homes, and probably more often than not new homes, probably mostly resale, but that's a stressful time for people anyway. Moving is stressful. Buying a home is stressful. Even if it's exciting, it's still, there's a certain element of stress there. So we're always dealing with people that are at some level of stressed out.
Well, and the nice thing about what you mentioned there about not having to change any contract prices over that time, you talk about stress. Not having that stress as a client's huge, because you see sometimes where, okay, we need to increase the price by 15 grand or 20 grand. And now they got to come back to me and get reapproved for that higher amount.
Right.
Well, maybe they're not approved for the extra 20 or 30 grand, or maybe rates have changed or something like that. It's a tough conversation to have for everybody. So good on you. That's
it's not
amazing.
ideal. I had one of those toward the tail end, COVID was behind us, but we were in what I call the COVID hangover phase, which was 2023, even into 2024. I did have I had a couple instances where we had a pre-sold home for a client that we had built for. The home was basically finished. We're 90% of the way there, and then they decided we're not going to be able to pull the trigger, right? So, and this wasn't a starter home. This was $1.2 million custom build.
It's a big undertaking.
Yeah. So, we ended up reselling. No harm done. We resold the property. We dealt with it. We all kind of took our lumps on it. It was not ideal, but we got through it. But I had another one, the same thing. The house pre-sold, very high end, custom build. Interest rates change, and they have an affordability problem. But it's we can't unbuild the house. It's finished,
and
right?
It's
finished,
custom.
And it's your house. It's the house we designed for you, and you chose all the finishes and selections and paints and flooring and cabinets. It's your house.
Well, that's
so we worked through it. We got to figure it out, but it's not ideal. But I'm able to work with my clients enough to figure that. I don't ever want to do that again. So anyone that's listening, I'm not suggesting we do that. I was cranky. We got it dealt with, but I was pissy for. I don't want to be a lender, right? I want to be a builder.
Well, that's one thing that I'll say, and I'll plug RBC here for a second, is with our builder program, the nice part is if you're telling me the build's going to take 12 months or 14 months or 9 months, no matter what it is, we give you that approval for that, let's call it 12 months. That client's approved for that 12 months. We're not going back. If nothing changes on the contract price, we're not going to check anything a month out prior to closing for something to happen like that. You're approved, you're done. And that's something that we love, because for you as a builder, it provides that comfort that nothing, as long as the build price doesn't change, this client's fully 100% in, right?
Sure.
And And the nice part is I had some clients in COVID. The way we do it is we add a little bit of a premium on to lock in that rate for a long period of time. I had clients that near the end of COVID, when rates started going up, they might have locked in that 12-month rate for 2.8%. And when they actually closed on their house, the real rates were like 4 and 5%, but they were able to grab that 2.8.
Yeah, that's a lot of money on.
Oh, it's a lot of money
or whatever it might be.
Big time. But security for you, that's the most important part, right? As a builder.
Yeah.
Any builder for that matter.
It's risky. There's always some element of risk. You start building a home for someone today and they don't pay for it till it's finished. And that finish line is, roughly a year out.
That's right.
For most builders, for almost everybody. So we've talked a bit. Mortgage rates have come down. We won't talk specific interest rates and mortgage rates because, we're all well aware that can change, and I'm not trying to hold you to anything, but they've come down, and we're in what, mid fours?
We're mid fours right now, yeah. And generally, yeah, the trend is they're starting to come down. Like when you look at specifics on one side, I can say 9 months to a year ago, like we're talking about rates in the sixes.
Yeah.
Right? And now we're in the mid fours. Now you've seen the Bank of Canada, you've seen the U.S. Fed start to drop their rates. Right? Next Bank of Canada announcement here is late October.
Yeah.
Be interesting to see what they do at that point.
Sure. Yeah.
Right?
Yeah.
So,
but realistically, mid fours is a pretty reasonable borrowing rate at anything, whether you're talking mortgages, car loans, whatever it is. Mid fours is pretty doable.
Well, and you've been home building for how many years?
19. It'll soon be 20 years. Yeah.
Right. As you said, fours is pretty good if you look at it over the last 20 years.
Sure it is. Sure
right?
it is. Yeah.
It's just those seem so high right now because people still look back 4 years ago during COVID
2%.
when they were 1% and 2%.
Yeah, sure.
Like, oh, this is so high. But in reality, it's not. It's right where they have been. And I always say, like, the few days to months before COVID, like, the rates were in those high threes. Right?
Yeah,
we're not far off that. Right?
Yeah, we're getting there. And there was recently a change with the amortization. 30-year amortization now.
Which is great.
Yeah.
Really, really nice. They made a couple changes, actually, and one that took effect back at the start of August, which allowed for first-time home buyers to go over a 30-year amortization, which will reduce their payment. I totally get that there's potentially a little more interest over the long term.
So it's only for first-time home buyers?
First-time home buyers, so bear with me on that one for a sec. So August 1st, they brought it out that first-time home buyers could go to 30-year amortizations on new construction builds.
Okay.
So whether that's, as you mentioned, a turnkey build or a draw mortgage, which that's where a client owns the land, right? And takes draws to pay the builder every so often.
Right. Yeah, we'll touch on that. Maybe we'll go into that in a little more detail shortly.
Yeah. So that change took effect August 1st.
Okay.
Just recently, they brought out, taking effect in December, that all first-time home buyers can buy any house, whether it's new construction or whether it's resale, 30-year amortization.
Okay.
But also, any person on a new construction home, doesn't have to be a first-time home buyer, can now do 30-year amortizations with as little as 5% down.
Okay, so let me get this straight. So first-time home buyers, whether it's new construction or not, can apply for 30-year amortization.
As of early December.
Coming up.
Yeah.
But what was the second part?
Second part is anybody buying a new construction home, whether you're a
first-time home buyer or not.
Yeah. So if I own a home, if I want to go buy a new home by yourself, I can go with 30 amortization with minimal down payment.
Okay.
Yeah.
And what is the? I know this might, we'll talk through it. I know it's probably better illustrated in written form, but what is the minimum amount that, say, a first-time home buyer is going to need to have down?
Yep.
5%?
Yep.
Okay.
So 5% on your first 500,000.
Okay.
And then once you get over 500,000, however much is over 5, it goes up to 10%. Right.
And then then it changes again at $1 million bucks?
Well, CMHC, so they brought it out. That's another change that's going to happen as well. They used to only insure mortgages up to $1 million. So if you had a purchase price of $999,999, you could put a minimum down payment down, which would be between that 5 and 10%. Okay. Right. Now they're changing that they're going to be able to, insured mortgages can go to 1.5. So that's a new change that's going to take effect on that December change they have. So, in the Halifax market here, it's going to be significant for.
So you could buy up to 1.5 million on purchase price and still put
have minimal
only
down.
10% down?
Yeah, it'll all depend. Like, again, it's 5% on that first 500,000, and then it gets tiered as you go up.
Okay.
So the exact penny, I couldn't tell you this very second,
Sure.
but yeah, the minimum down would probably be under 10% for sure.
Sure. You know, especially if we talk first-time home buyers here for a minute, and in fairness, we don't build a lot of homes for first-time home buyers. I'd love to. There was a time when we did more of it than now, but unfortunately, a combination of new construction pricing and land pricing has pushed the cost of the starting point, I guess we'll call it, of new construction for single-family home builders like myself. I don't build condos and I don't build townhomes for sale. So single-family units have been pushed for when it comes to most first-time home buyers. Not a lot that are considering new construction, you know, because we're probably starting somewhere 600 and up these days.
Yeah.
So if you're searching for a home at 400,000 or 450, it's going to be a tough thing to find. I'd love it. I wish I had 100 of them that I could build tomorrow.
Right.
But it's just the math just doesn't.
Well, the land
The
here
land alone is
becoming expensive. Yeah, absolutely. Yeah. And that's one thing they've realized. Like, these changes are Canada wide. They're not Nova Scotia and they're not Halifax, right? So you got to take into effect everywhere in Canada. The nice part is you know what? They've gone to 30-year. Again, you're going to pay a little more interest, but you know what? It's going to keep that payment a little lower. That 400, 500 budget you're looking at, that might be able to go 500, 600 now.
okay. Yeah.
Because of that 30-year amortization, right? Could be the same payment as that previous.
Right.
That doesn't change the effect that they still need to have the down payment,
Right.
right? Which is difficult now, especially with like rent prices.
Yeah. Sure. It's hard
Right?
to save.
It's hard to save.
Hard to save.
It's very hard to save in this world. Groceries, rent, you name it. You know, life's expensive.
Yeah. Sure is. Folks will call my office, and their questions are 80% of the questions are the same that people ask, and one of them is, you know, where do we start? How does this work? How does the process work? So if somebody's talking, how does the process work for getting a mortgage?
Yeah.
They've never bought a home. They've never spoken to a mortgage specialist. Oftentimes that can be intimidating. I can tell when folks call and they talk to a builder and they're kind of, you know, they'll say to me, they'll go, look, we don't even know where to begin. I don't even know what questions to ask you, right? So we just have a conversation like we're having here and you get to the bottom of it. But what is the procedure? What would you tell, whether it's first-time home buyers or folks that are, you know, they're buying their first home and they haven't done this before? Where do they start when it comes to determining what or if they can afford to buy something?
Well,
I mean, I know there are online calculators. We've all used them.
There is.
You can punch in some generic, you know, punch in some numbers and it'll give you a general idea. But when they've decided I want to speak to someone.
Yeah. I always say on that, and you hit the nail on the head with, you know, use some of these payment calculators, you know, online just to see, a $500,000 mortgage is roughly $2,500 a month or whatever that number is, just to give you an idea. Say, yeah, that could potentially be done. Sure. Then when you're ready to go to that next step, yeah, it's me, right? It's talk to your mortgage specialist and see what that affordability is, because what we're going to do is we're going to get your income documentation. We're going to get your savings that you have. We're going to check your credit history. And within that meeting or two and providing that information, we'll be able to give you an exact number.
Okay.
And those numbers are usually locked in for about 120 days that you can have those. So we can say, hey, Ryan, you know, you're pre-approved for $562,000 with, you know, 5-7% down payment.
That's right. And then they're going to come to me and say, hey, Ryan, we've been pre-approved for $562,000. We'd like to talk about building a home. And I'm going to say, okay, well, we're not going to look at $562,000. Let's look at a house that costs $500,000 or $530,000. So you have a little wiggle room, especially on the new construction side.
That's right.
But yeah, it's very rare that someone would come to me as a home, I don't mean me specifically, but come to a home builder and be starting the conversation of building prior to them already having spoken with their mortgage lender and figuring out where that number is. Because when they get to us, we need a number to work with. We need a number.
That's right. And that's the same with home building. That's the same in buying resale.
Absolutely.
You know, you go to your realtor and say, I love this $700,000 house. Well, what do you approve for? I don't know.
That's right. Yeah.
Right. And then you go to, they take you to this house and you're wasting the realtor's time. You're wasting your own time. So
absolutely. And the other thing that you're doing, and when I first, before I was a home builder, I was a realtor. I mean, I still have a real estate license, but I don't practice real estate in that sense anymore. I don't work with buyers. I don't list other people's properties for sale. But there was a time when I was running all over the place showing folks houses and helping them buy homes, and going to look at a home. I still say this to folks when they talk about even with new homes. But let's say for argument's sake that you've been pre-approved for $500,000 and you're ready to buy your first home, and you have a realtor and you're ready for your realtor to start showing you some properties. That the last thing you want to do is go look at $700,000 homes, because then when you go see $500,000 homes, they're not going to be as impressive.
No.
You're not going to like them as much. It's like going to the car lot, right? And you walk in and you think, and you go, look, I've got $30,000 to spend on a car. Well, if you tell the salesperson that you have $30,000 to spend, they're not going to test drive $50,000 cars.
That's right.
Because then it's going to be a tough sell to get you to enjoy or be as interested in a car that's worth less or a house that's worth
That's right.
less.
Well, and the big thing about it is, and you see it a lot more now, and this is one kind of thing that I find COVID kind of sped it up a little bit, is providing that pre-approval letter, either A, when they're coming in to talk about a build with you, or B, buying a resale home. Mm-hmm. Like, as you said, you have your real estate license. I know you don't take people to homes and sell those kind of things, but let's say you did have my house for sale, and I get 2 offers that are the same price, same closing day, nothing different, but one of them had a pre-approval letter with it and one of them didn't. I can tell you right now which one I'm taking.
Sure. Yeah, for sure.
Right? So I already know that client's ready to go. So that's going to be the one. So it benefits you as a buyer. Do your due diligence. Use me, right? If you're good to go, great. Let's go to the next step, which is talk to the builder, talk to your real estate agent.
Sure.
If it doesn't work, well, we understand that off the start. And that's where myself and advisors will be able to say, this is what you need to do to get to the position you want to get to.
Yeah, and I can tell you from a seller's perspective, from a home builder's perspective, I've had this happen a number of times over the years. Recently it happened. This year, I believe it happened earlier on this spring. What you don't want to do as a buyer is make an offer on a property and then have it not come together for you because you're unable to secure your financing because you didn't secure that. You didn't look into that enough beforehand. Because now what you've done is you've, in your own mind, you've started to zero in on this house that you want to buy.
Yeah.
And you've started, now you're expecting, now you're starting to picture yourself in that home and you're visualizing living in the home and you're going through your 10 days or 2 weeks of due diligence. And if it doesn't come together, you'll be disappointed. But the seller and or the builder will also be cranky.
Yeah.
Because they assume, as a seller, when somebody makes an offer to buy something, you assume they have the money to do it.
That's right.
Right? It shouldn't be, that part shouldn't be up in the air. It should be, that's just a formality. It's just a formality.
Yeah.
Right? So if you've been approved for X number of dollars and you buy a home that is X number of dollars or less, then the financing part, once you've papered your document, your purchase agreement, that should be a formality.
Yeah.
Right.
And I like to talk about the difference in a pre-approval and approval is your pre-approval is approving you as a client, saying this client has good credit history, the income, everything is supported to purchase a house that's $700,000. The difference in an approval is the approval now takes you as a client, which we've already got you pre-approved, but we also have to approve the house or the property.
Yeah, it's property specific now.
So it still does take a little bit of a time. So why we always recommend getting that pre-approval there is I have your income documents. I have everything up front. You mentioned it. You have 10 days to get this stuff in order. Right? I don't want you chasing around T4s, asking your boss for a job letter. You're locked out of your pay stub system.
You don't have time for that.
You don't have time for that. If we have that, we have that up front. That's one thing off your plate that you don't have to worry about.
Yeah.
Let us do this. If an appraisal is needed to confirm the house as an approximate value, great, we do that. And then we give you that official approval. So the big thing, pre-approval is you as a client. Approval is you and the host being fully approved.
Yeah, that's a good point. That is a good point. There's a good distinction between those two because people will even use that pre-approved thing fairly loosely. I'll get people that will say, yeah, we've been pre-approved for X. And then you kind of talk to them a little bit longer and you realize they completed one of those online calculators and it spit out a number based on the information that they put in. And perhaps they're correct, but not quite the same as if they've been speaking with a mortgage specialist who has confirmed their employment documentation and done a credit search and knows all those things and then says you're pre-approved for X.
I'm not giving a pre-approval letter unless I have all the income docs.
Right.
I mean, you can tell me I make $60,000 a year. Well, you know what? Show me.
Sure. Yeah, of course. Because
Right.
you're going to ask for it when the time comes to get
Right.
specific. So yeah,
That's
you
right.
want to do that ahead of time.
The last thing you want is you saying, yeah, it's $60,000. Okay, you're pre-approved. And then you actually get the income docs and it's $56,000. I get it that it's close, but hey, sometimes that's the difference in what you want and what you don't want.
Yeah, don't round up your income.
No,
don't
not
round
at
it
all.
up.
And guess what?
If anything, round it down.
That's
baby.
it.
Round
That's
it.
exactly
If you
it.
make 56, call it 55. Leave yourself a little wiggle room. You mentioned on one thing was that I wanted to pick your brain on was just general advice that you'd have for folks when they're at that stage where, maybe they've saved up what they figure is going to be 5%, let's say, of whatever value they've determined is affordable for them. That's the other thing too that I always tell people there is what you can get approved for, what the lender will give you, and then there is what you're comfortable spending every month on a mortgage payment. And those two things are not necessarily the same, but it's the latter that's most important.
That's right.
Don't make yourself house broke.
Well,
right?
you got to look when you're doing an application. You may hear people talk about debt servicing and what percentage of your income goes towards bills. That's one of the things that we look at when we're doing a mortgage application. But everybody's is different, right? So someone might have daycare costs and someone might not.
Sure.
And that doesn't take effect in certain positions. So it's really a case-by-case basis that you got to look at and say, you're exactly right. You might be able to afford $2,400 a month, but I might not because I have $1,200 in daycare bills.
Sure.
So even though we're pre-approved for the same amount, we're kind of not because it's just not comfortable for me.
Sure. Yeah.
So
absolutely.
you're absolutely right. And that's why I say every client, every situation is different. And I like to talk to the client about that rather than giving them a number.
When you look at credit rating nowadays, you see commercials every day on TV. But now there's an app or many of them. You can track your own credit. You can keep track of where your credit rating is. Is there a certain number that, because I find some people get really obsessed with that.
Yeah.
Right. But at some point there's got to be a number where, it's just kind of good enough. It's beyond that's great, but you know what I mean? I wouldn't.
Yeah. I mean, a lot of it depends on some background history, but usually if you're 700 plus, you're
sure,
okay.
Yeah, that's what I figured.
Like 900 is a perfect credit score.
Right.
I've been doing this for 15 years. I've seen 8 perfect credit scores in my life. And I'm doing a lot.
Yeah, and there are some things that happen to the folks that are used to determine that credit score that aren't quite so straightforward. Like folks just think, if you pay your bills, you'll have perfect credit, but there's a little more to it than that.
Utilization, how much you're using, how much is left, making sure you're making full payments on time and how long you've had it too. Mm-hmm. I talk to people in their mid-20s and they're like, oh, my credit score is not as high as I want it to be. I'm like, part of that's just age.
Part of that's you're in your mid-20s, yeah.
You're in your mid-20s. You don't have a lot of credit history to have, let's say, that perfect score.
Sure.
Right? But that's not saying your credit's bad.
Right.
Your credit's really good for your life stage, and it's not stopping you from potentially getting a home.
Yeah, that's important.
So I have a lot of those conversations with clients about that, and I'm like, hey, your credit score is 815. Like,
yeah, you're good. Sure.
Pat on the back. That's a good score.
And that's just, that's just one part of what you need to be concerned with. There's credit rating, income, other debts and payments that you have, and student loans, and car payments, and all those things. Debt service. There's a number of things you guys look at, obviously. That
the
beyond
big ones,
credit rating,
credit bureaus,
Yep.
which is your credit rating, and then your debt servicing ratio, which I mentioned is your income. What percentage of your income is to bills that basically report in your credit bureau, and your mortgage, and your heating, and lines of credits, and visas. That incorporates what your income is and everything. So that kind of does everything as one. So that's what I say. Debt's not a bad thing, but you just don't want to necessarily have, people have car loans.
Sure.
That's pretty standard in this world right now, right? I get it. When I pull a credit bureau, 9 times out of 10, there's a car loan there, and that's fine. It's just the other stuff that you just want to make sure is getting paid down, because the lower it is on the value, the less it's affecting that ratio, which potentially the more you can get in your house.
Right.
Right. But
what about,
it's interesting.
Sorry, I mean, cut you off there, but what about, I was just thinking about income. When you said that, I thought popped in my head. It was always, and I assume it's still the same case, that there's a bit of a challenge when it comes to self-employed income. Those folks are fighting a bit of a different battle than other folks. And it used to be a 3-year thing? Is that still roughly the same idea?
We use 2-year average.
2 year
is what we use. We use 2 year average on self-employed income.
Okay.
There is some special programs that you can have with self-employed, because I get it. We understand. I mean, you're self-employed builder. Your situations are different,
sure,
right? You know, writing down income, doing other things. So
it's just so many people are self-employed now,
right?
Though, right. It's not, business owners aren't the traditional business owners where you have to have
your box
bricks
store
and mortar store
Absolutely.
and a bunch of employees. You could be self-employed. You're just one person.
That's right.
Whatever it is.
Consultants,
exactly.
real estate agents.
Exactly.
Right?
Yeah.
Perfect example, real estate agents. So yeah, we have some special programs around stated income to be able to do some things with their income. But again, it's all dependent. If their 2 year averages are great, hey, there's just the same as doing a normal mortgage application for a salaried employee.
Okay.
But the 2 year average, and the reason why that is we just want to see if what you're doing is sustainable, right? We don't want to have 1 year of $95,000 income, 1 year of $31,000, the next year at 92, the next one at 30, right? Like that's a very tough situation. It's up and down and it's very volatile. Mm-hmm. So we just want to see at least a couple years in a row. Very, very similar to a salaried employee when we use bonuses, right?
Sure.
If you get a bonus, let's see your 2 year average on your bonus.
Okay.
Right?
Yeah, that makes sense. We talked briefly, I'll come back to what I mentioned earlier. You had mentioned, made the comment about new construction mortgages specifically, and we talked turnkey versus, progress draws and whether or not if the homeowners own their own land and so on. So I'll explain that just for a minute, setting aside the mortgage side. In the new construction world, you know this, but for those who don't, in the new construction world, we have essentially two ways of doing this. We have turnkey new construction, whereby the builder sells the land and the home together, one property, to the buyers. They buy the property and the houses on it. Now that could be, the home could have already been built. That's probably the most common scenario. So those are non-custom builds. Those are your volume builders. You show up, there's the house, it's built, or it's under construction perhaps. Or it's made to order. Could be custom built. But again, it's the builder owns the land. They're going to sell you the land and the final built product. And that's more similar to a resale mortgage in the sense that
very similar.
It all happens at the end.
Yes.
Right? The payment happens at the end.
You have a deposit up front.
That's right.
And then at the end, you have the residual
The deposit
funds.
may vary depending on builder. It may vary depending on the level of customization of the home.
That's right.
That there are different things that could affect the initial deposit. And usually that deposit is, in most cases, probably held in trust at a real estate brokerage trust account or perhaps a lawyer trust account. Sometimes that deposit may be paid directly to the builder, again, depending on the level of customization and different scenarios. But then the other scenario would be when the homeowners or the property owners already own their land. And so they hire a builder like us to come in and build a home for them on their land.
Yes.
And in that scenario, the financing works differently.
Big time.
So those folks have to make payments as they go. And it's normally in the form of draws, and it can vary from lender to lender. And so we won't worry about specifically that, but it could be somewhere 3 or 4 draws, somewhere roughly in that range. So that's a scenario where when the home hits certain milestones of construction, the builder will submit an invoice to the client, say, here you go, we're at 25%. We need, essentially, for argument's sake, we need 25% of the contract price now. And there are other things involved. Now, the bank is going to, if this is, of course, assuming the person is borrowing money.
That's right.
If the person's not borrowing money and they're just writing checks from their checking account, then this
Completely
next part
different.
doesn't apply. But
that's right. That would be nice.
Yeah, wouldn't it? That is nice. And that doesn't happen very often, but that's sweet. When that happens, that's awesome.
That's right.
That's good stuff. But for most folks, that's not the case. There's some amount of money often being borrowed. So the home hits a certain milestone, and then that's when the process starts. And so the buyer then has to contact their lender, and the lender contacts an appraiser, and the appraiser goes out and confirms that the house is indeed at X% complete. And then they process things and take some time, and away you go. So it's a more administratively intensive process.
That's right.
For everybody, the builder, the buyers of the home, the mortgage lender. Now we involve an appraiser. The lawyers are getting involved, moving money around. So it's just more involved. It's more involved. But you have to do it that way if you own the property. So as builders, we're not going to build $1 million home on a patch of dirt that you own and have you just pay us at the end.
Next, you're $1 million into it.
That's right. Because if 90% of the way into it, you decide, I'm out of here. I'm going to back across Europe and lose my number. Well, we're stuck. We can't sell your property.
That's right.
Right. So it can get really ugly very quickly. But more importantly, it works the other way as well in turnkey, whereby if the home builder rather, is building a home for you and selling you the home and the land all inclusive, you as a buyer are not making payments throughout the process because you don't want to have a bunch of money tied up in property that you don't yet own.
That's right. You don't own it.
The builder could take off, or the builder could go bankrupt, or something could happen whereby now you're stuck. Now your money's stuck.
Yeah.
So your exposure is always limited to perhaps your deposit, and even then, that could be held usually in a trust account. Yeah. So very little risk for homeowners or buyers when it comes to buying homes, but huge risk for builders if you're building a home on land that somebody owns, especially if they get. I've had a few instances where it can get awkward.
But the risk I feel like is it's always on the builder. Like, and that's what clients have to realize is builders, no matter if they're building it on your land or their own land, there's a risk. And you've basically said a few. Builder builds it on their own land and the buyer backs out halfway through. Well, the risk on the builder is now they got to resell this house. Mm-hmm. Maybe there was a little bit of customization on that. And if you're building on the client's land, well, we just said your risk is that you're putting stuff on this client's land and you don't have money until these draws come out.
That's right. Yeah.
Right. So, for all the clients out there that are looking at doing that, like the builder's doing you a very big favor no matter what way you go.
Yeah, and people will often ask, like folks will ask us if it makes any real difference to us. And in fairness, I don't really care. There are advantages and disadvantages to each for both of us, you as a buyer, me as a builder. I don't necessarily. The situation dictates how that's going to work anyway. It's not like we're going to.
That's right.
We're not going to change it. I'm not going to sell you the dirt, the land only, just so that we can do progress draws. The only reason people would do that anyway, the only real logical reason would be if they want to save deed transfer tax. So in this part of the world, we have deed transfer tax, which is here in Halifax area, it's 1.5% of the purchase price pre-HST, but let's not confuse it even more. But 1.5% of the purchase price on closing, you're going to write a check to the municipality. Yep. Your lawyer's going to collect it on closing, and so if it's $1 million, it can get to be a pretty significant amount of money. But like you mentioned before we started, and I'll let you talk more about it. But there's also, in fairness, those savings that you might see by not paying deed transfer tax. In other words, only paying the deed transfer tax on the land value instead of the land plus house value. You also are going to have interim interest that you're going to pay.
That's right.
When you start drawing down your mortgage, well, now you're spending interest. So if it's 10 or 12 months till the house is finished, you've got
that's a lot.
Months of interest. Yeah,
absolutely. And I would say a lot of the time it works out pretty similar. Give or take a little bit, right?
I would think so.
And I don't think that's by chance.
If you factor in the other tangibles, not financially related, but other tangibles of more administrative work that's involved and a little more stress involved and running around and cutting checks and getting money orders and so on, it's probably minimal enough that I think everyone would lean toward turnkey if they had the option.
I fully, in the other one that goes, like I have a lot of clients that come in and say, buying my land, getting the builder to do it because I can save, as you mentioned, I can save on that land transfer tax. Mm-hmm. But you mentioned $1 million house. You need that first draw 3 months in once you got things started to frame and it's a $200,000 draw. Well, now you're paying interest on that $200,000 for the next 8, 9, 10 months.
Right. Well, the second draw is coming a couple months after that.
That's right.
Now you're $500,000 into it and you're going to pay interest on $500,000 for 6 months.
That's right. And again, money's going to the lawyers. You're getting appraisers out there. You're just doing a lot of behind the scenes work that causes stress for some people. Our whole goal is to not cause stress.
Sure.
And that's where turnkey is great. And I know you mentioned not everybody can do a turnkey.
And not every builder will do turnkey.
That's correct.
Because some builders, quite frankly, they can't bankroll it.
That's right.
So they need you to make payments as you go. And, other builders will do costs plus. We don't build cost plus. You're probably familiar with that though.
Yep.
Where in a cost plus scenario, essentially your builder is taking care of everything construction related, but all of the bills are passed through. They collect the bills in one way or another. They hand them to you and you write a check for that amount plus some predetermined percentage. But those builders are not bankrolling the build.
Yeah.
And you're out of pocket constantly as a buyer. You're constantly carving checks to the builder who's
And again, you got to be the right person to be able to do that. Like, yes, the approval process on affordability on a turnkey to a draw is very similar, but that's where it starts and stops.
Right.
You talk about draws. Let's say you want a $200,000 draw. Well, what we do is we send the appraiser out. And if the appraiser says this house is a certain amount completed, has this amount left to be completed, we release that appropriate amount of money compared to the mortgage. Well, if you want $200,000, but that number is $174,000, that's $26,000 short. So the client's got to be able to come up with that money for that draw for you.
Yeah, exactly.
Now you're going to get the full mortgage amount over the course of the build. It's not that you're getting cheaped out on not getting enough money. You're going to get the money you're approved for. It's just a matter of when.
Yeah, this is what we run into. This is where it can get, sometimes I feel that it's not my place as a builder to explain this process. It would be up to the lender, the mortgage specialist, whomever. I will say, anytime that we have clients that we're building for, we do build folks at any given time. We have the majority of our stuff is turnkey, but we always have folks that we're building for that are doing progress draws because we build custom homes for folks who already own their land. They may have owned it for years, and they come to us and say, look, we're looking for a design and build. We'll go to the land, we'll design something that fits and make work. But that part's more cumbersome than turnkey for sure.
You got to have a fair bit of cash on the sidelines for those that contingency.
Exactly.
Yeah. And not a lot of people realize that when they first come to the table, and then we have that conversation. But it can get awkward quick, and it's difficult from a home builder's perspective. You touched on it, but if we say, for argument's sake, the first draw is from the builder is 20% of $1 million, and so okay, we're at that point, we're at that milestone. Here's your invoice for $200,000. But if you're only borrowing 50%, let's say, and I don't want to throw exact numbers around because I know there are other factors here, and whether or not they have how much of their land is being used for down payment or however you call it, but generally speaking, let's say for argument's sake, the simple math is the invoice might be $200,000, but perhaps your lender is only sending you $100,000. So you've got to come up with the difference, because the builder, doesn't matter where the money's coming from. The builder doesn't care where you get the money from, but they need the $200,000 to keep going, right? So, and I've had instances where that process perhaps wasn't explained well enough to the folks that were buying, and this is where I got sidetracked. I will say, when we're building for folks who are doing progress advance mortgages, when they're dealing with RBC, I am far more comfortable than some of the others. I think RBC does the best job at, I know that really, I've heard from many different lenders, nobody really likes doing this. It's a lot more work. It's a lot of work.
It's a lot more work, and it's a higher risk too, right? It's a higher risk to the bank. It's just, it's generally not something, you're not going to have many people talking you into it, I guess, we'll put it that way. And so, but RBC is great to deal with. When I have folks that are in that scenario and their lender is RBC, I breathe a little easier on that one than some others.
It's a thing we pride ourselves on, really, in the construction world, and it's firm approvals. That's that. I can't stress it enough. And you as a builder would absolutely love it. When we're giving you an approval, it's an approval.
Right.
As long as everything is as is per the contract, we're not coming back on that.
Yeah, that's good.
You're going to get your money, and it's firm approved.
Yeah.
Like that. That's a huge thing where potentially some other lenders, again, are checking the credit history or redoing something closer. You've changed jobs. Oh, we can't do that anymore. And I'm not. That's fine. That's how they do business. One of our things that we pride ourselves is our construction side of things, and that firm approval. It's huge. One of the other things that is great for clients, one of the things that I talk about a lot is for the entire process of that build, turnkey or construction draw, the clients get life and disability insurance for free.
Really? Okay.
So if something happens to them during that build, guess who it protects as well? Protects you as the builder.
Yeah, of course. Yeah.
Right? Important. They get that free. They can, once it's done built, they can do what they want. They can keep it, they can whatever they want to do. Always recommend having that insurance, but at least for the cost of the build or the length of the build, they're getting that for free. Just a nice little thing they have there.
That's good. Are you seeing any, kind of jumping around here, but on the, when interest rates started lowering there a few months ago and maybe hopefully even continue to lower, did you see an uptick in interest? Like was your phone ringing more? Were you hearing from people that you Or was there anyone that was on the fence, perhaps, that said, okay, now things are moving in the right direction, let's revisit this?
Yeah, I have a kind of group of clients that I've talked to when the rates were higher, and they're like, keep in touch with me when rates start dropping a bit and we can re-engage in conversations about it. And that's helped a bit. I find I get busy the afternoon and the day after whenever the Bank of Canada meets.
Okay.
Right. And that's where clients are like, oh, the Bank of Canada lowered interest rates, your rates must be lower. Well, it's not necessarily, it'll affect the variable rates on a mortgage, but not necessarily the fixed rates.
Okay.
So
well, most people wouldn't know that.
But most people wouldn't know that.
No.
And when fixed rates drop, most people don't know it exactly, right? So it's having those conversations and it's keeping up to date. Yes, when variable rates drop, it's the Bank of Canada dropping the rate. Variable rates tend to drop with that. It's pretty cut and dry.
Right.
But the fixed rates is having those full conversations. But at least that gets those people talking, right? And then I can say, hey, actually, rates are down 30 or 40 basis points over the last 3 or 4 months or whatever they might be. And you know what? Your pre-approval that we had at 380 is now 420 or 430.
So you've been doing this for a while now. So are most of your clients, or how would your new clients break down proportionally? How many of your clients would be new to you each year, roughly? Any idea?
Yeah.
I don't expect you to know. That's like when people say to me, people ask me all the time, how many homes do you build? Like, I don't know. Yeah. I don't know, man. I could sit in my head like, count them up, this many, but I don't track it that way. I know it sounds weird.
I can tell you what I hit on the 7th hole 10 years ago on one of the courses, but I don't know
what club I hit.
Yeah, exactly.
How the wind was blowing.
Yeah. You know what? I'm doing, I don't know, in the 100 to 150, 175 mortgages a year.
Okay.
And it's starting, there's a lot of first-time home buyers. And I have the benefit of having RBC behind me, right? I work at the Bedford branch, clients that walk through the door and help
So do people walk in, just walk through the door and go, hey, we're looking to perhaps buy a house, and who can we talk to?
And the other thing is if people are working with their financial advisor and working with them for months and months and years about not just necessarily home buying, just about their own personal financial status, home buying is going to come up in that conversation.
Yeah, sure it is. Yeah.
Right. Yeah. So lots of new clients every week. I don't know the exact number, but I would say,
but some portion of your business is folks you've never met before, and
a fair bit of it is. I would say 60-70% of it probably is, to be honest.
So when you first started out, would that number have been higher when you first started? Like when you're first, okay.
Yeah.
And like anything, you get into it and now you have repeat customers. You have folks that are probably on their third or fourth.
Yeah. So that number I find gets a little bit lower and lower every year because you're getting more of those repeat clients.
Right.
But you're still going to get the brand new ones, whether it be from the branch or, a center of influence or a realtor or a builder or something like that. So, and to me, as you can see here, I'm a talker. I love talking to new people. I love hearing their stories and everything. So it's great.
Good. That's good. Yeah, we haven't actually, it's not that we've done a tremendous amount of business together, you and I. But we've only kind of been known to each other now for a couple of years.
Yeah, a couple of years now. Yeah.
We are doing some business together now, but I've never really had, like a go-to mortgage specialist person because again, 99% of the time, by the time folks get to us as a home builder, they have that part already lined up, right? They've already started that process. Very rare for somebody to walk through the doors or call us for the first time, looking at building and being ready to build, I should say, being at that point where we're ready to start talking numbers, and for them to say, oh, a mortgage, what's that? Oh, we've never talked. So most people have that figured out, right? Most people are getting to you before they get to me.
And that's a good thing
and they
for
should
you.
Do that. I want them to do that. Yes.
Absolutely.
If they haven't, I'm sending them to you, right?
That's right.
That's when they go, okay, what's our next step? Well, your next step is give Kyle a call and then give me a call back when we have some numbers to start working with.
That's the thing. You want to protect yourself, right? And that's what it's all about. You build a great house, you want to protect yourself. So, hey, if they're with RBC, as you mentioned, great. If they're with another financial institution, that's fine. Would we love to have them with RBC? Absolutely, every day of the week.
Sure.
But I do understand on that side. It's just making sure they're in the right place to purchase one of your homes.
Sure.
Right?
Yeah, cool.
And in how that happens, it can be a number of different ways.
Yeah.
That 30-year amortization, taking it from 25 years, that's significant.
Yeah, was there anybody that kind of reached out to you when that news hit? Okay.
Absolutely. That can change a couple $100 a payment or more
on
a monthly basis. And guess what? That's a lot of money for people. So when looking at homes, the affordability, that can make a big difference.
Sure.
So I think that's one of the big things that they've done, the government's done over the last little while. That's been a real good thing.
I've told people before, because I've seen it done. I've seen this happen so many times. It's just human nature. It doesn't mean that they're a bad person, but I've seen people sort of not quite tell the whole story. So they'll come to you and say, I make X number of dollars, but they kind of neglect to tell you that they have a $40,000 student loan, or there was a time back in university when they were a bit irresponsible and they ran up a credit card and never paid it and it went to collections. So sometimes that happens. I've always told most people, or what I've told anyone when the conversations come up, is just be honest. You're not getting away with this.
No.
There's nothing to get away with here. So just take it head on so that you can get a real number. And not only that, the person you speak with, the mortgage specialist perhaps, may have some advice for you on how to deal with that, or put it behind you, or make it less of a factor.
That's the big thing. And I can't stress it enough, whether it's a new home build, whether it's a resale, is pre-approval.
Right.
Pre-approval.
Right.
Because you just hit it. You have no idea where you stand until you actually do it. Mm-hmm. You can tell me you make this amount of money and you only have this debt. Well, let's pull the credit bureau. Let's see what is here.
Sure.
And then if not, well, I know with us here at RBC, we like to take that client and say, okay, this doesn't work right here, but let's sit down and have a more in-depth conversation of where you want to get, what you want to do.
Sure, yeah. I've seen some awkward scenarios. One time I worked with a couple who were looking to buy a home, and they met with their mortgage broker and they did their thing. And sometimes you learn some things about your other half that you didn't know.
Been there. I've seen it.
That can be awkward.
That's a tough one.
That can be awkward, yeah.
Yep. Where I had some clients email me prior to the meeting and say, don't say this publicly.
Sure, yeah.
Right?
Yeah, sure.
And I'm like, well, it's on your credit bureau. Like, it's going to affect this mortgage application.
Right, yeah. You can not bring it up, but you're not going to be able to ignore it when the time comes. So,
that's right.
Yeah.
That's right. So
basically, just try to get your ducks in a row as much as you can, and then take that information and go talk to a mortgage specialist like yourself and put all the cards on the table.
And then talk to you.
Yeah, and then come talk to me, or go, find a realtor and go buy a resale home if that's the case.
Yeah.
But do that part first. That's step one.
It's all just about doing the background stuff.
Yeah.
Right? It's just like you building a house. You're not just going to go start making a foundation, framing a house. You do your due diligence. You get architect plans. You do everything like that.
Yeah. Yeah.
Exact same for the client, but easier, really.
Yeah, sure.
Let's come talk to a mortgage specialist for a little bit. Let's get the pre-approval.
Yeah, a few days back and forth, send some emails.
That's it.
Scan an email, something, take a picture.
We can do a pre-approval pretty quick. I always say this. Pre-approval can be done as quick as you want it to be done.
Sure.
If you want it to be done quick, get me your documents quick.
Sure.
If you're not in a super rush, well, I'm on your time.
Yeah,
right?
that's similar parallel there with us on the new home side of things. Folks will come to us and say, how long does, common question we'll get is, how long does it take to design the home and finalize the plans and put the contract together? And I always tell them that depends 100% on you.
Yeah.
I can pull a plan. I've drawn, I design all my own homes. I draw my plans. I don't draw them in CAD. I design them, and then my staff puts them in CAD file. But I've told folks before, we can have a contract tomorrow if you want.
Yeah.
I have everything I need, but is this the house you want? I don't.
Yeah, I have no idea.
We got a lot of stuff we got to cover here first, but it's not a matter of how quickly we can do it. It's a matter of how quickly, at what pace you can move.
Yeah.
And we're not trying to push anybody along to move the pace any faster than they're ready to go. But some things take time, and do them in the right order, and everything will run much smoother.
You just be upfront with them, right? And that's one thing that I always say is when clients come to my office, I'm like, hey, I'm going to tell you exactly how it is. Mm-hmm. I'm not going to sugarcoat anything. This is what you can afford. This is what you can't afford, or this is what you got to do.
Sure.
Because if we start sugarcoating things, saying, well, maybe this, kind of like you said, maybe this, maybe that, or looking at $700,000 house, you only afford $550,000. Mm-hmm. It's just not healthy for everybody, anybody for that matter. So you know what? Here's what it is. This is what you can do.
Sure. And then if you're not ready now, then I know you guys will work with. I've seen lots of examples where now you're not ready now. Either you haven't saved enough money, or we got to take care of this. We got to make these last few payments on this car payment or whatever it might be, right? We've got to get this credit rating up a bit. So I assume sometimes you probably just have some marching orders where you can tell folks, listen, go away and do these few things.
Absolutely.
And then in 6 months' time, you should be in a position to make this happen.
Yeah, and we try to sit down. Like if I'm sitting with, I mean, I can comment on RBC, is if I'm sitting with Ryan McNeil in the office and we got to do some changes to get to where you want, I'm bringing in a financial planner or financial advisor right in that meeting.
Mm-hmm. That's interesting.
And saying, okay, here's Ryan. Tell them right here, this is where we're at and this is what we need to do. How about you two set up a plan to get to that point?
Yeah, that's good.
Because I do
That's
mortgages.
Great.
I don't do the investment side anymore or that. Sure. So we just get them so we're on. And again, it comes back to how much does the client want it? If they want it, they'll work with that and stick to that plan.
Mm-hmm.
If buying a home is not a pressing need, maybe
we have a similar. Right? We would, in a similar fashion, there would be scenarios where folks might come to us and say, we would like to buy this particular home or build this home, and it's going to cost X number of dollars. But we've got a home to sell first. So, we don't know what that's worth. We have an idea. We're not really sure. And we might, same thing whereby you bring in your financial planner and some other folks. What I'll do is bring in or put them in touch with a realtor who can go to their home and give them an idea of what really it is worth and how long they might expect for it to take to sell. And some of those things that would clear up some of those questions.
That's right.
So that we can keep the process moving without having so much of a question mark.
That's one of the biggest ones now with construction mortgages of non-first-time home buyers.
Sure.
Is I want to build a house to you, but all my money for my down payment is in my existing house.
Right.
And I don't want to sell it until my new house is done.
Right.
So that's where we sit. That's where I have very in-depth conversations on, okay, let's look at a worst-case scenario here. Worst case, your house doesn't sell. Mm-hmm. Do you have minimal down payment to be able to put on this or things? And we talk about those options and we can see, you know what, there's a way that this can be done, or you know what, you're going to have to sell your house. Mm-hmm. Sometimes we can be able to give you the approval letter by saying, yeah, the client has a minimal down payment for this house, which is fine. But a month or two before closing, their house goes in the market and it sells. Well, there's nothing stopping us from increasing that down payment to make it higher for them. You're still getting your money. Person, so we can change that as we go a bit.
Yeah, and most people, by far, when it comes to new construction, when it comes to any purchase of a home, most people have to sell the home they currently own before they're going to be in a financial position to purchase the new home.
Yeah, in general.
In most cases. Right? There are exceptions to that. There are folks that could, in theory, carry two mortgages if they need to and if there's an overlap and so on. But most folks, whether it's 600,000 or 1.6 million, most people have to sell that house. Yeah. For most people, the majority of the money they have, at least that they can liquidate, is in equity in their home.
That's right.
So, they need that to make it happen.
Well, and the other thing is, the point we're at in time right now is some of these people got their mortgages 2 or 3 years ago when they were 2%. And to be able to port that mortgage over to the new house to retain that rate on that amount of money, they have to have their house sold.
Sure. Yeah. Sure.
Right.
Yeah,
within a certain time frame, right?
Yeah, that's a good point.
If not, they're going to buy a $1.6 million house at, let's call it 4.5% or roughly. Mm-hmm. So if they want to keep that existing rate, they got to make sure they line up within a certain period of time to do that.
Yeah, true. Yeah, that's a good point.
So
anything else, Kyle, that you think you want to touch on here?
We got a lot going on there.
Yeah, we've covered a lot.
Provide a little bit of knowledge for some people.
But yeah, thanks for being here, Kyle. Again, Kyle Selig, mortgage specialist, RBC.
Absolutely.
Extraordinaire.
Thank you very much.
All right.
I appreciate
Thanks,
it, buddy.
Man. Appreciate it.